Okay. Well, thanks everyone for being here. I'm with Ross Hargrove with Texas Farm Bureau, and just had some good information that he can put out that's important to know for people looking to buy, people that just already own homes. He's an expert in all realms of the insurance world. So, Ross, you want to give us a quick introduction?
Yeah, thank you for having me, Chris. I appreciate it. Yeah, I'm Ross with Texas Farm Bureau Insurance here, and I'm in Waxahachie is my office, but I service all Ellis County, and then really anywhere in Texas, we're free to free to help anybody and everybody. But been in the business for 6 going on 7 years. I love what I do. I love being able to help people, and I appreciate you asking me to come on this call today because there really is a lot of stuff about insurance that some folks just don't have the opportunity to know, and sometimes they find those things out when it's too late, and then that's a scary time. So my main goal with what I do with my business is to help people and make sure that they're protected the right way. And I do that. Some people call it old school, but I do a lot of stuff in person still because really I believe in having a personal interaction with all my insureds and all my clients, make sure that they understand what they have because you spend a lot of money on insurance over the course of your life. You deserve to know what you're paying for and what you're getting and what you're covered for. So that's just a little bit about me and what I do.
Awesome. Well, I appreciate it, and we'll dive right in. So,
All
the
right.
first question for you is just at a high level, what should a buyer or current homeowner be looking for when they're looking at home insurance, that the policy and everything of that nature?
Yeah. Okay. So there's a lot of things that I think people should look at. The one thing that people always go to immediately is going to be cost. They're always looking at price, which is important. And we'll talk about that here in a second. But almost more important than that, especially right now, is number one, we'll start with a company. You need to look at companies who are, I think local is important, especially since they're going to be familiar with the area and, the houses that they might be insuring. They need to know where those things are. But just having somebody local that they can go and talk to in person or whatever their need, they're right there. And what you run into sometimes is there's some companies that use third party adjusters to handle claims. And a lot of times those guys don't know who you are. They don't, they're not even from the state. And so dealing with the claim side of things can be kind of tough. So local is always important. And along with that, when you're looking at what companies to choose, and we could go into some details on policies as well. But I think look for a company who has a good reputation. There's if you can just do a quick Google search and you can tap up different company names and read reviews about them and see how they handle claims because really your insurance company is only as good as their claims handling process. But I always caution people, be a little bit wary about the companies who are brand new to the insurance game. There's normally some red flags there. So they've been in business for a long time. They have a good reputation. I think those are all very important things.
Yeah, because I guess and I've seen this, and I'm sure you've seen it on your end. Like, I know the first time I bought a house, I was looking strictly rates, what's the cheapest, and am I wrong to say that sometimes you find out the coverage isn't there when you actually need them? So you kind of that's to your point of finding the balance between a reputable company and how they handle claims versus just the cheapest thing you can find.
Yeah, absolutely. Because, especially when we are buying a house or we're in that process, sometimes what we're thinking about is just, bottom dollar that we just want to get things as cheap as we possibly can. Well, on the one hand, it's good to save money. But on the other hand, if you go really, really cheap, there's going to be things that are going to be left out on that policy. And just to your point, you might find out that something was left out when you need it and when you have that claim. And that's just a really bad time to find that out. So,
Usually when it
um,
happens.
yeah, win. Yeah, exactly. And so now I always recommend to people look for something that's, it's a fair price, not the absolute cheapest. Now you don't want to be spending a ridiculous amount of money, of course. But that's why I sit down with people to help them decipher what they need, maybe some things that they might not need, while still getting them a fair cost. And with things the way they are now, people are looking at cost a lot more, but you still have to remember the other side of things. To if you're not going to do the insurance route, there's no sense in paying for it at all. So
Yeah. And that's a good segue into, I mean, everybody's talking about the cost of things and the price of things these days. Inflation is affecting everybody across the board, regardless of industry. Can you tell us a little bit about how insurance is being affected by inflation, if at all, and kind of what we're seeing that's different due to the inflation?
sure, that's a really good question. So right now, the inflation is impacting every facet of life. And unfortunately, insurance is not immune to that. As much as I wish it was, everything has a trickle down effect. And in the insurance industry, what people are finding is every insurance company in Texas had to take a rate increase. And the reason being, well, there's a bunch of reasons, but let's just talk about home insurance, for example. What it would cost to replace a roof now versus or a house compared to what it costed, 3 years ago is way, way more. Or let's talk about, the auto insurance side of things. If you have to go replace your car, that you get your car totaled right now, what it's going to pay out now compared to what it would have taken, 2 years ago is changed dramatically. Just take vehicle parts, if you have to get a new fender, what that new fender is going to cost now versus what it was is so much more. And so insurance, a part of what, their rates are based off of is how much they pay out in claims. And so when the claims frequency one, but also more importantly, severity increase, then the only way to stay in business is to increase premiums because we're paying out so much more on the back end. It's a tough thing to deal with. And, we have people who are calling all day long that they don't quite, they understand, but they don't like the answer. But really, it's a tough time right now just in life for everyone. And what we have to be aware of is, with us, with Farm Bureau, we took the stance of, we didn't do it without weighing the options very, very heavily because we understand how much it impacts people. But the good thing is, and I won't talk about other companies, but we didn't take near as much of a rate increase as a lot of the other ones did, which I appreciate. But to answer your question, inflation is impacting everything. And so therefore the insurance industry is getting hit hard, just like, interest rates and everything is changing. It's just something that we're having to navigate through. But that's why it's even more important to know what you're paying for.
And it's interesting because we're kind of starting to see the trickle down effect of, as you mentioned, lumber prices of homes being much more expensive. And everybody thinks about when they purchase a house, that's more expensive. Hiring a contractor is more expensive. Same with cars, like auto parts. Used cars have probably higher value than they've had in a long time just because of how hard it is to get parts. And that's slipped its way now into finally affecting your insurance because if the insurance is paying for it, those costs have to fall to somebody.
Exactly. And that's something else too that I meant to mention is we're seeing the effects of it a little bit slower on the insurance side of things. It's all this stuff is affected and then it hits us. It's kind of like one of the last things that it goes down to because it's a little bit longer of a process. And no, you're exactly right. It's
So before we jump from this, just last couple things, are there any specific areas within someone's homeowner's insurance policies they should be looking at that we're seeing changes kind of across the board? If there's one or two things that really kind of hone in on over the next 6 months or so.
Sure. There's a few things. Number one, we want to talk about some of the changes that are going on in the insurance industry as far as policies go. And then there's some things that you always need to check on. So one thing that there are some companies out there that are doing this is in response to inflation, trying to find ways to alter their rates in a sense, is they're going to change the deductibles on a person's policy. Generally, I will write a 1% deductible. So which means if you had to use the insurance, you pay 1% of whatever the value of your house is. And that's how much you have to pay in your deductible. There's some companies now who are changing that to 1.5% or even 2%. And that's a scary thing. And some folks don't realize they have a 2% deductible until it comes time to actually have to use that insurance. And then they're saying, hey, I'm paying way more out of pocket than I thought I was going to have to. So the deductible is a huge thing. Companies are changing that.
So that's basically if I had a $500,000 house, initial deductible might have been $5,000 before insurance starts coming in and paying for things. Some companies, it'll be up to $10,000 on that $500,000 house before they start spending it on.
That's right.
It's a big jump.
Figure out.
It's a big
it's a lot of money. That is a lot of money. And it's scary to find that out. So the deductible thing is huge. There are some companies out there who are also changing how they're handling roof coverage in general. So we'll talk about some of these other things here in just in a moment. But basically, if you had to replace your roof right now, you need to be able to have the full amount that you need to replace it. So let's just say if it costs $20,000 to replace your roof, you need that $20,000 because that's what it costs right now. Well, there are some companies who are changing it from true replacement cost to what's called actual cash value. So basically, replacement means you get what you need to replace it. Actual cash value means they have to depreciate it based off how old it is. So long story short, if you have an older roof, but you have an actual cash value policy, you're getting way less than you really need to replace that roof. And that's a bad deal.
So,
You're paying a lot of stuff out of pocket.
so basically now, if this is the policy and whatever insurance, you got to look for this. I could potentially buy a house that's got a 15-year-old roof. They're going to say the cash value of that roof at this point's $10,000. But then when I need to replace it, it's $20,000. So I'm not getting that difference. Is that correct? Like, is that basically
And
instead of them replacing the whole thing for 20,000, they're only paying up to what the cash value was of that roof at the time?
what it's worth right now. Yeah,
Okay.
exactly. And that's and not everyone's doing there. There's select a few select areas where that's happening. And like I said, I'm not going to mention companies or anything like that. That just goes to show how important it is to read your policy and see what you have specifically. But that's a big thing that there are. I've heard of changes going on in that area. And then another big thing is just on water damage in general. And so when we had the freeze a couple of years ago, there's a lot of people who found out what their water coverage really was or was not. And once again, bad time to find those things out. But on water damage, you need to make sure that if something were to happen, if you had a pipe break underneath your slab, or you had a hot water heater burst, or, whatever appliance, anything appliance related, you need to have water coverage to fix that stuff. And there's a lot of policies out there who maybe they don't have that water coverage like they need. Maybe it's capped at $5,000, maybe it's capped at 10. Regardless, water damage can be one of your biggest expenses aside from a roof claim, for example. And if you don't have what you need on that, then you're really going to be up a creek.
Yeah, it's important stuff because, a lot of times you only think about the home insurance policy when you go to buy your house. And then unless you see a crazy
Exactly.
spike, you don't think about anything until you go to buy your next house. And so
Right.
it's just a good reminder of keeping an eye on your policy and its coverages
For
consistently.
sure. That's right. That's
Um,
right.
Kind of moving off of that a little bit, but in the realm of owning a home, uh, you could go to one agent, one insurance agent. And this is for everybody to know if you didn't, and they can help with not just home insurance. It's not like it's just a home insurance agent, just a car insurance. Across the board, you could go to one agent. And a big thing, especially when you become a homeowner, is life insurance. And I'm going to break this into two parts. But first, can you just explain a little bit of what risk you're running if you buy a home and then you don't have life insurance?
Sure. It's one of those things that oftentimes people don't want to think about or they don't want to talk about because it's uncomfortable to talk about death, of course. But the fact is, the reality of life is things happen and crazy things happen when we're not expected, we're not planning for it. And when you're buying a house, I bring it up to every homeowner that I talk to, but when you're buying a house, you're taking on more debt than likely you've ever had, especially a first time home buyer, more debt than you've ever had in your entire life. Some people, but 300, 400, $500,000 in debt on just the house, not to mention what you might owe on your cars or your credit cards or anything else, or the income, of each other. There's a lot of things that play into it, but if you're not protected for that, if something happens, take a married couple, if something happens to me, what's my wife going to do? How's she going to stay in that house? She can't. You have two income families. They're using two incomes to put the pieces together right now. Imagine how hard it would be if one person didn't make it home. And so when people are buying a house, that's something that has to be thought about and prioritized because if something were to happen, it can just devastate a family financially if they don't have what they need. And I was talking to you, I'm dealing with a death claim right now. Some of my clients passed away, and seeing that whole thing unfold is hard. But luckily they had life insurance and they're going to be okay. Their family's going to be okay. But it often gets overlooked, but it is so crucial.
Yeah, and I especially realized that through talking with you, Ross, and then my wife and I, we have three properties together, and so that works when we have, as you said, two incomes. But the most expensive one is the one that's in my name, and that's the most debt that would get carried over to her if I were to go. So it's kind of a realization of, not leaving somebody in a bad spot.
That's right. That's
Um,
right.
and
Exactly.
so I guess the last thing on that, can you touch a bit on, because different ages, different points of your life, there's different types of life insurance. Most notably to me is term and whole. And can you
Mhm.
briefly describe kind of which each are and when one might be more beneficial versus the other?
Sure. That's a good question. So there's term than whole life or permanent insurance, like you mentioned. And really, I will start by saying it this way. there's you can't put just a cookie cutter plan for every single person. Every family is going to be different. Every plan is going to be different, and what your needs are versus my needs are going to vary. So I believe that every individual client needs to look at the full picture of things. But just when you break it down, term insurance is like renting, and then permanent insurance is like buying. So term insurance, you're covered for a specific amount of time, 10 years, 20 years, or even 30 years. And during that period of time, you're covered. Your rates don't go up. You have that coverage. But at the end of that term, then the coverage goes away. And the money you've paid into it, you get nothing out of unless, of course, something happens to you. But the good thing about term, you can get a lot of coverage. It doesn't cost you hardly anything. Term insurance is dirt cheap, and you can cover yourself for your biggest need for the period of time when you really need it the most. So take example, a young family who has kids in the house. They need a lot of coverage, to cover all their house off, for the husband or the wife's income to keep those kids to where they can, handle life, without the parents there. So term insurance is really, really great. It's temporary though, it runs out. Then permanent insurance or whole life insurance is like buying a house. So, take your house, you pay it off, but you get to keep it. It's yours forever. That's the same way as permanent insurance. You pay on it. And, with our policies, you pay on it for 20 years. At the end of year 20, you're done paying, but you get to keep that coverage forever. It's going to be there no matter what. And along the way, it's built cash value. So the money you've paid into it, your cash equity is going to equal, generally, depending on what time or how much you did. But the most important thing about it is it's always there. The coverage can't go away. You can't outlive it, I guess. And so now there's some, I will say this, there's been some people who've looked at whole life insurance in a negative light because they don't understand all the details and what it's for. The purpose of whole life insurance is to guarantee you have coverage for your whole life, to make sure that's always going to be there. Generally, what happens is, you could outlive your term, and then you have to go do a new term and then a new term, and you're just kicking it down the road, and you never quite give yourself covered forever. Because everybody's going to have less expenses. Hopefully we live to 85 or 90 or something, but there's always going to be those last expenses. And so, sure, you can save your whole life and plan for those things, but you could also do a permanent insurance policy that forces you to save it. It's built cash value along the way. Or if you just want to take the cash out and use it for whatever you want to, you can do that too. So, but those are two different types: temporary and permanent.
Yeah, no, and I appreciate you touching on that because that's something before sitting down with you, I didn't really know a whole lot about. I just knew there's life insurance and I'm young.
Right. Exactly.
And didn't put as much thought into it until I started kind of accumulating a family and things that come with that.
Sure.
Well, so I got one question here from Mike, if you could kind of dive in a little bit deeper.
Yeah.
So your deductible, is that based on the sales price of the house when you purchase it? Does it change with the appreciated value? Can you talk a little bit about what that deductible comes from?
Yeah, that's a really good question. So when you insure a house, generally what insurance companies will do is they will run what's called a replacement cost estimation, and they're going to put the values into their computer into a system that we use, and it will tell us based off current values what it would take to insure that house, what it would take to rebuild that house today. And so we'll look at the sales price, but that doesn't always reflect what the insurance value needs to be. So generally what we will do is we'll say, okay, based off square footage, the location, all these factors, your house needs to be rebuilt for X. And so we'll insure it for that amount. And so the deductible is going to be based off of how much that house is insured for. Now, generally what happens too is some companies will, over a year's time or 2 years, depending on the market, sometimes they will increase that coverage a little to keep up with, the rising cost of materials and everything. If that's not going on, they keep it the same. But generally it increases a little just to help make sure you're protected in the event that something were to happen.
All right. Awesome. Well, I appreciate that. I'm going to just pause the recording here.